Hello, good morning and welcome. You've tuned into ET Now and you're watching Buy Now, Sell Now with me, Varun Hiremat, and along with me, Karunya Rao. Let's take a look at the markets this morning. Of course, it's something a little different to what we've gotten used to over the last couple of weeks. It seems that the rally is cooling off, although slightly. The Nifty is actually in the red today, and I can't remember the last time I've looked at Nifty and seen it in the red at 11 a.m. So today is definitely a bit of a cool off. Clearly, the breadth indicates that we have 32 out of 50 Nifty stocks declining. So that's clearly spelling out that there is some profit booking happening in the market this morning. However, within that, you still have your select performers that stand out no matter what. And part of that today is an SBI Life and an HDFC Life really shining out. Two big names from the insurance pack. So insurance showing some good resilience. Bajaj Finserv, Grasim and GAIL also holding out in the green. On the flip side, you have Techem, L&T, Titan, Coal India and Adani Ports, both those numbers cooling off slightly. We'll be revisiting the markets throughout the show, but for now, we are pretty much just recovered from the low point of the day in the last few minutes. We've been joined by a very special management this morning, the management of Capri Global. Mr. Rajesh Sharma is now with us. Good morning, sir, and thank you for taking out the time to talk to ET Now, and especially us here on BNSN. Could we talk about the quarter that just went by for you? Seemed to be a bit muted on the credit growth and on the net interest income front. Could you talk about the factors that led to that, please?
Yeah. So Q3 has been a very good quarter for us in terms of disbursement, where we have grew almost about 82% on quarter and about 28% on year-on-year basis. We have reduced our high-yielding book of construction finance, and that has resulted in a slightly lower net interest income, and cautious approach in terms of providing provisioning have led profit to be flattened. But if we see that our granular book that has shown a high growth, and I think next quarter is going to be even much better.
Okay. Can you also tell us how disbursements and collections shaped up?
So disbursement, as I said, we have grew MSME in affordable housing segment. We have focused on that, and as compared to last year, year-on-year basis, we grew our disbursement about 28% in MSME and affordable housing, and quarter-on-quarter basis, we have grew about 82%. So if you talk specifically about the segment, then MSME loan disbursement grew about 60. Affordable housing grew about 67% on Q-on-Q basis and 132% on year-on-year basis. And if you talk about MSME grew about 82% on quarter-on-quarter basis and about 46% on year-on-year basis. So there has been good growth in terms of disbursement on the retail segment side. However, on the construction finance side, we are a little cautious, and that book we have not grew. In fact, that book have degrew, and on overall basis, the book have remained flattish, and we are able to maintain our delinquency very good. Collection with a strong about 185 people on ground, and with the help of a lot of analytic model and a strong persuasion, collection has been better than all the quarters this quarter. So when we started moratorium, and as compared to this, we already reached the pre-COVID level collection efficiency.
Right, Mr. Sharma, that's heartening to know. Could you just give us the collection efficiency percentages once again across the books if you have it? And then given that MSME is such a large portion of the total AUM mix, what's the outlook on the sector going forward? Do you think there was anything notable in the budget which came forward which might perhaps reignite momentum within MSME sector?
So if we talk about collection efficiency in the bucket of X bucket, collection efficiency is about 91%, which is almost nearly COVID levels, and that is what on the expected lines. If you talk about regarding the budget. I think if overall spending is going to grow, that is going to help MSME, that is going to create more demand for the MSME loan, and more affordable housing demand will come up. We are clearly seeing the finished houses are having a surge in the demand. And plus for NBFC, specific per se, there's a reduction in SARFAESI limit from 50 lakh to 20 lakh rupees. So I think that will also going to help NBFCs in terms of speedy recovery of the bad loans and reduced time of recovery. So overall credit cost, it will show a positive trend because of that too. So overall, I think if the demand goes up for the loan, I think it is going to be a benefit for everyone.
Okay. Given the current market dynamics, Mr. Sharma, what is the outlook for the next fiscal? Where does the key focus lie? What are the segments that you as a company will be focusing on?
So our key growth driver is going to be MSME loan and affordable housing. Basically, they are of the same product, two variants, same geography, same customer class of no income proof customers, and in tier 3, tier 4 towns. So that is going to be our strong focus. Currently also on overall basis, about 80% book is retail book, where average ticket size in MSME is about 17 lakhs and affordable housing is about 11 lakhs. Currently we are operating through about 80 branches with the help of about 1900 employees. Going forward, we are in discussion with a few consulting firms, what kind of a new product we can add. We are mapping the market, competition, and we are going to add a couple of more products of the same customer class. How do we can do the cross sale? How we can bring down further our the cost income ratio and improve our profitability. So this year we'll see that we should be able to launch a couple of more products as a pilot product. And once we refine them, we are going to full-fledged start lending towards that. So I think by next year, by last quarter of the next financial year, we should be able to start a couple of more product towards lending. Before that, we'll prepare that technologically architecture, a selection of the product, building the team, and then expanding that also.
Right, sir. And finally from us this morning, you mentioned cost of funds is coming down, but what about availability of funds? If you want to aggressively grow your housing book and the MSME book going forward, how's the current funding environment, and what are the various avenues you're tapping to access capital?
So I think funding is not a problem for the company like us, whose book is granular, delinquency is good, and profitability, we have always been profitable. So currently we are having a liquidity of about 2,000 crore rupees, including drawn and undrawn limits. And besides that, we are having about 24 lenders who has given us repeatedly money whenever we require. So funding is not going to be a challenge. If it regards cost of fund, since last year, we have already reduced our cost of fund by 100 basis points, and all the new sanction in NBFC are happening in the level about 8.25%, and in housing finance, they are happening about 7.75%. Plus, NHB is giving a refinance limit in the range of about sub 5%. So I think cost of fund has come down. However, we have also passed on that cost of fund to our borrowers, and that is helping us to target a better customer, better property, better profile, and our customers are also benefiting from the lower rate of interest.
Okay, great, Mr. Sharma. Good to chat with you this morning and getting in a perspective of what is it that Carefree Global will be focusing on to drive growth from the current levels. Thank you once again for joining me. Moving on, and both joining us right here on the show. Morning, gentlemen. Kunal, first to you for your high risk and low risk bets.
So good morning, Karunya. I'll be suggesting two buy calls at this hour, and expecting that the markets would remain a bit more stock specific and get back into some sort of a consolidation on the indices at least. But stock specific, I believe that there could be more opportunities which could be thrown up. So two specific stock ideas. First one which I'm suggesting is Ban ACE, or Action Construction. We don't talk of this stock that often, but it's done remarkably well for itself over the last few weeks and months. In fact, the stock has more than doubled from its March 2020 lows as well. So at current levels, the stock is at at a very strong set of momentum burst, which could probably take the stock higher to almost 188, 190 kind of a zone. So expecting a continuation move for Action Construction, suggesting a buy with a target of approximately 188, and stop loss could be kept at 158. The second is a buy on HDFC Life. Now this is more of a low risk trade in the morning show as well. I had given a buy on HDFC Life. I still maintain the stance that many of these insurance stocks are looking quite strong. They have just come back to breaking their previous swing highs and now looking for one more round of trending upside in the near term. So for someone who's looking out for more of a gradual moving kind of a stock and slightly low beta, I think HDFC Life could fit the bill there. Would suggest a buy with a target maintaining at 744. Stop loss could be tailed higher to 700.
Okay, thanks for that, Kunal. Gaurang, hi, good morning. Thanks for joining in on BNSN. What's on your radar today? High risk and low risk calls for our viewers.
Thank you, Varun, and morning to all of you all. So, we have always been suggesting low risk long-term investment idea on the fundamental side. So there are two of them. First one is on fallback of great set of numbers, continued run rate of improvement. HDFC Limited, the largest player in the HFC segment, that is housing finance companies. And given the outlook on loan book growth and of course the turnaround that we are seeing in the real estate sector and the likely possibility that the run rate of registration likely to go up and the demand for residential housing going up, we've been maintaining a positive stance on HDFC Limited for a pretty long period of time. We reiterated our buy call on HDFC Limited recently with the third quarter numbers gone by and upgraded our targets to 3,100. So, and of course, given that you have a correction in the market since second half of yesterday continued today, I think it is prudent for investors to look at strong fundamental stories, investment ideas, if you will. And HDFC suits perfectly over there. So 3,100 is the target on HDFC Limited. The second one is from the mid-cap private sector bank universe. Of course, not a name that normally is spoken about, but great set of numbers for the third quarter and the outlook for the fourth quarter and the next financial years to come by remain equally strong. City Union Bank, 210 is the target. Now, both these targets are long-term targets, so would request investors to have a longest time horizon in case if they decide to invest in both these names.
Okay, all right. Kunal and Gaurang, request you both to stay on with us. We'll slip into a break here and address viewer queries when we come back. Welcome back. You're still watching Buy Now, Sell Now. Gaurang and Kunal both are with us to help our viewers with their queries. First up, we have a Twitter query from Nageshwar Rao, based in Hyderabad. He is planning to buy Apex frozen food at the current market price and wants to know if it's a good time to dip in. Kunal, first to you for the technicals. The stock has cooled off from its recent highs of about 320, 325 rupees odd levels. Right now at 275, good level to dip in?
Well, frankly, I don't, look at the stock, that closely. I don't track the stock that closely. But then I was just looking at the charts, for Apex, Foods, especially in the last 3-4 months from the November lows when the stock actually managed to break past about the 200-day moving average. There is a different sort of a trend which has come back into this name. On the very, very short-term charts now, I'm not sure what the time horizon is of the viewer, but if it's restricted towards, say, from a trading approach, say, with a time horizon of, say, a couple of weeks or at least a couple of months, then I believe that these could be good levels where he can look to, trade as well as, go for a short-term investments. Even though, it's more towards doing with some technical triggers and technical indicators which are showing some signs of a bottom formation at current levels. I believe you could probably see an upside of, another 20 to 25 rupees from current levels. So very closer to 300 is where I believe, a near-term target could be kept at Apex, Food. But purely that this could be just, a trading idea, more of a, short to medium-term kind of a time horizon. If you're looking to, look at it from a longer-term view, then I wouldn't recommend. But from a short-term view, especially looking at the way the stock charts have been structured, I think you can potentially see at least a 20 to 25 rupees on the upside from current levels.
Thanks for that, Kunal. Gaurang, I know fundamentally speaking, Geojit might not really track a stock like this, but it is cheap. And if you go back a couple years, it used to be a 700 rupee stock nearly at one point in time. And of course, now people are talking about shrimp consumption going up as bird flu has created some concerns around chicken. So, I mean, what would you do here? Do you even look at stocks like this, or maybe would you consider an Avanti Feeds, which is also in shrimp but a little different?
So we have coverage on both the stocks, and Varun, over here, let me say this, you are absolutely right. This is a stock that has seen 700 kind of levels and then it has cooled off. Now, we have coverage on both Avanti Feeds as well as Apex Frozen Foods. The only thing that I would request Mr. Rao is that be prepared to withstand the volatility and ups and down moves that this stock will throw at you, given the kind of news flows surrounding the stock. But if you're looking at it from a long-term point of view, yes, we have a positive coverage. What I would advise is that don't go ahead and invest all your money at one time. Start investing at current levels, maybe 25, 30, 40%, and on dips you can go on adding to it. But the caveat still remains, Varun, that this stock can throw a lot of volatility at you. So you should be prepared to digest that.
Okay, so quite clear from Gaurang, he's got coverage on both the stocks and the coverage is positive, but near-term volatility is something that you're going to have to digest. So interesting, shrimp stocks are in focus there. Let's switch gears toward banking. Meghna Shah of Mumbai is asking if we would recommend buying IDBI Bank at the current market price, pending its PCA clearance. So Kunal, any signs on the chart that investors are getting more bullish on IDBI post its possible exit from PCA?
Varun, I think the stock has just shown signs of some recovery in last 1 month. I think from the Jan end lows, I think if I'm not wrong, it was around 25 or 26 and a half kind of levels for IDBI Bank. I don't see a major recovery which is panning out, and even though if it's a short-lived recovery, it's not altered the course and the trend for this stock. So it's very difficult to say that the stock would probably perform very well on long-term charts. I would completely I would recommend to completely avoid this name if it's specific to that kind of news flow. In fact, if you're looking at banking stocks, then I would strongly suggest SBI as being one of the top candidates for a buy on portfolio. I think the stock has given a 10-year breakout. We were discussing this yesterday as well on the show, that how SBI has broken past about almost a 10 to 12-year kind of a high, breaking past about the 350 mark. And whenever we've seen such kind of a phenomena where the stock breaks past about a 10-year high, you've seen the stock going into multi-years of uptrend. So purely on the charts, I believe SBI could be a much better bet. So I would advise the viewer to look at this stock rather than looking at IDBI Bank.
Okay. Gaurang, do you have a similar view on IDBI, or do you differ from Kunal's opinion?
So, Karanya, PCA clearance and divestment should not be the only reasons why you should look at a stock. And, most of the time, Karanya, divestment from the government side, the news does come, but the action comes in pretty late. And in absence of time, valuation, as far as divestment is concerned, I would not really think that would be a great idea to go and buy the stock, because you're investing your money on a lot of hope, and hope sometimes disappoint in equity market. We don't cover IDBI Bank on the fundamental side, but I would request Meghna that if you're looking at investing afresh in small or mid-sized banks, so in mid-sized bank, I just recommended City Union Bank. Amongst the smaller private sector banks, we are positive on Federal Bank and IDFC First Bank. I think these two would be a preferred investment idea, purely on the fundamental I'm talking
about. Okay, well, thank you so much then for joining us, Gaurang and Kunal, and sharing with us your view on host of stocks that we wanted to address. Moving right on, the markets might be lackluster, but there's one stock that's gaining quite smartly in trade, and that's Muthoot Finance. They delivered their Q3 report card as well. Let's touch base with George Alexander Muthoot, the MD of Muthoot Finance. Thank you so much, George, for touching base this morning. Q3 has proved to be a good quarter with several achievements for the company coming in. Can you tell us what exactly were the key highlights or the key factors that aided your stellar performance?
Yeah, we have been able to do a milestone growth of 50,000 crores in gold loan AUM. It's the first time we are reaching the 50,000 mark. That's really a landmark achievement, and we are really proud of it. And secondly, our profit has also gone well. Growth is there in Q2, Q3, etc. And Q4 also we expect good growth. So the factors which are there are actually, we are now, our presence is there, the public perception is good, the demand for gold loans are good, and we have a good, strong customer base who are coming back to us again and again, repeat customers for gold loan. That is our strong, that is the basis on which we feel that we were able to achieve this good growth in this quarter. And surely continuing also, it should be like that.
You've also seen a 32% growth in gold loan AUM. How do you see AUM growth shaping up from these levels as per earlier guidance? Can we expect a 15% sustainable growth from the company?
So if you take for this particular year, from March to today, we have already grown by 22%. That's more than a 10,000 crore of actual growth we have already achieved in this first three quarters itself. So we had given a guidance of 15% or probably better in this year. So since you have already achieved the 22%, we expect this year we should end up by 25 to 26% growth for the full year. That is for Krit's year. And going forward, Muthoot has always been giving conservative guidance. So we will surely say that going forward also in the years to come, we should grow at least by 15% every year. Please mind you, this is all on an increased base. So 15% every year is something which we will be trying to achieve. And as usual, if things are good, if things are okay, the market is okay, the environment is okay, then we should see more than 15% also. But 15% is what we would like to give a guidance for the coming years.
Right, so hi, this is Varun Hirimath also joining into the conversation. What's the outlook on asset quality on a sequential basis, and where are they trending, and the total provisioning that you currently have on the books, where does it stand?
See, if you look at the gold finance company, gold loan department, 90% today of our assets are on gold loan. So today we have 50,000 crores of gold loan and probably only 5,000 to 6,000 crores of other businesses. So in the gold loan section, there is actually no NPAs or no asset quality issues at all. Because whatever you see as a stage 3 asset or so, which is about 1.5% in the books, that is just loans which have crossed the threshold time limit only. But we have the gold with us and we don't expect a credit loss there. So actually the provisioning, etc., which we give is only for regulatory purposes. In fact, actually we have never had to use any of these provisions for maintaining the quality. The quality is already there, and if there are any issues with probably spurious gold or stolen gold, etc., that is written off in the current quarters itself. So what you see in the books, there is no need of any provision, but statutorily we are asked to keep provisions, and that's why we are keeping. That's a 1.5% provision.
Right, so then what is your credit cost guidance for the rest of this year? And is there a case possibly for margins to expand from here on out?
Yeah, our credit costs over the years have been about 10 crores to 15 crores to 20 crores every year, which is considering our total income. It is only about 0.3 or the AUM, which is less than 0.03% of our total assets. So the credit cost is negligible every year. We expect to continue with that going forward also. As far as the margins are concerned, we would like to keep a spread of about 10% in our books. So if we would like to keep that spread on the interest we collect and the interest we pay. So that is what we would like to continue. If the the cost of borrowing comes down, we will definitely pass on that benefit to the customers, keeping our interest spread intact.
Okay. Right, so and just a couple last few follow-up questions from us today. What is the growth outlook for your non-gold businesses? I think we've understood gold quite well, but what about the other segments?
See, non-gold business a year back constituted about 13% of our total book. Today it is less than 10%. In the last 1 year, we have been having only a calibrated growth in the non-gold loan business, especially the housing finance, the affordable housing, as well as the vehicle finance. Actually, these two businesses have reduced their AUMs because collections are coming, and the new loans we are calibrated growth only is there in the new loans. So that portfolio has come down a bit, but the microfinance portfolio is doing well. It has about 2,800 crores of portfolio, and it is doing very well. They are back to normal, and their collection efficiency, new lending, etc., is on track. Whether the gold loan, the vehicle finance portfolio is just 420 crores, and the affordable housing portfolio is only 1,800 crores. Those two sectors, we are not aggressively doing it now. But having said that, I'm definitely sure that it is not only the gold loan business which can survive in the days to come. There is always space, there is always need for vehicle finances, there is always need for affordable finances, but the market needs to settle.
All right. What is the incremental LTV on gold loans given the increased competition that you're seeing from banks and other financial companies?
No, actually, our LTV is capped at 75%. Even though it is capped at 75%, not all customers take 75%. Even on a day-to-day basis, it is fixed on the daily market rate. Not everybody takes 75%. The average disposal on a day is only about 69 to 70%. That means that all customers don't take 75%. Some take 60, some take 65. But majority of customers would like to take more of the 75%. We wouldn't want to increase that from 75. Of course, regulatory also it is not possible. And we, from our side also, we wouldn't want to do it more than 75%. Then you asked about competition. Competition is now, there is competition from banks, etc. Banks are doing this business. They are also getting business. Some of the banks have shown good growth. But what I say is, Muthoot has also grown well. We have actually done better than last few years. That means the customers, it is not that somebody else is taking away our customers. Our customers definitely are coming to us. We are also getting new customers. But a new set of customers are going to banks. The banks, the big banks, the nationalized banks, the public sector banks, the private sector banks, all these banks are also doing this. So customers are now looking at this option also as a source of finance. And that is why new customers definitely are going to banks. In short, the market is increasing.
Okay. Mr. Muthu, thank you so much for joining us then and speaking to us about a host of developments that took place, the key trends that are emerging and the way forward for Muthoot Finance. The stock continues to rise, up 5.5% as we speak. Slipping into a break here. More management interactions and market updates coming right up on the other side.
Hi, welcome back to Buy Now, Sell Now here on ET Now. We're joined by a very special management. Amit Agarwal, the Group CFO at Raymond Limited, is now with us. Good morning, sir. Thank you for taking all the time to talk to us here on ET Now. Of course, Raymond is in focus for a lot of investors. And based on the recent numbers which have been reported by your company, we'd like to know how has demand fared if you were to break up the year, H1 and H2. Are you satisfied with the level of recovery that you're seeing, or do you anticipate a further acceleration towards normalcy in the quarters to come?
Yeah, no, absolutely. I think there's a sea change if I look at it between the H1 and H2, which has been clearly witnessed in the Q3 performance. We have seen a significant impact of the unlock, where all the stores got opened all across the country. So we were very satisfied with that the stores were able to open. Even the shopping malls, the cinema theaters have progressively started to open. People have started to come to the stores. And obviously we manage all the right procedures for the health and safety. And after that, if I look at it, the wedding season and the festive season with the Diwali and the Dussehra, which really propelled the customers, our consumers, to come to the stores and pick up the various fabrics or the other demand which they wanted. Second thing, we have also seen that people who have not been able to shop for a longer period of time during the lockdown, they wanted to come and express their desire to shop, which has been reflected clearly. And if I look at our TRS stores, which is the core strength for the Raymond Group, all across 600 plus cities in India, we saw a very good recovery coming back there. People, especially on the fabric side, they have come around and bought fabrics for their needs, whether it is for the wedding season or for the festive season, festivities, they have come around. And if I look at it, and Raymond is a diversified conglomerate, so you see the engineering and the auto business, as all of you are fully aware, that auto sales are at a record levels, and we have witnessed both in our engineering and auto sector also very, very sharp recovery, and even exceeded the pre-COVID levels in both these sectors. Then on the real estate side also, if I look at it, because of the reduction in the stamp duty, as well as the all-time low interest rates on the home loan, we have seen very significant bookings in our Thane Realty project. We sold 179 apartments during the Q3. So all in all, we say there has been a very good recovery across the businesses. Obviously, we expect that the recovery will be at a certain pace. We do not believe that in this fourth quarter, in the current fiscal quarter, we will see the 100% recovery back. But we are seeing an improving trend compared to the H1. Clearly, H2 is significantly better. As we have told earlier, around that 75 to 80% recovery level, we are seeing that to happen in the H2 across the businesses. And going forward, maybe in the next fiscal, let's say 21-22, we should be seeing by second or the third quarter almost full recovery to be back.
Right, sir. And, talking about some of your input costs, of course, there's been a lot of fluctuation in domestic cotton prices lately. We're picking that up from various cotton producers. So what has been the consequent impact of that on your raw material costs going forward, and how do you plan to hedge against any volatility in cotton prices going forward?
So look, for us in the cotton, we consume the cotton not so significant in many areas. In our denim business, we consume the cotton. But since we have bought most of our customers in the international markets for such product, we are able to pass on to a great extent. Second, it is going to impact the overall sentiment of the industry. However, for our main business, which is the woolen poly wool, we have not seen a dramatic increase in the raw wool prices. It continues to be lower. There is a small increase. I would not say absolutely at the lowest level. There has been a small increase, but in the overall scheme of the things for us, the raw material constitutes not a very significant portion because it's all a design and a fashion. We are not in just a commodity play. We are in the fashion play where the raw material cost is a smaller component. And considering the strength which we have in our products, we are able to pass on here and there the price increases.
Given the higher discounting trends, how do you see the margins panning out? And even in the quarter gone by, what's been the impact of discounting on the margins, and how are you managing your liquidity situation and working capital management, etc.?
I think that's a very good point that in the Q3, we have seen ourselves that since there were inventory and sitting in different products, be it the shirting fabrics, be it a little bit of the suiting fabric, on the apparel especially. So we have also gone out and given some discounts, which has impacted to an extent a gross margin. However, our working capital management, I think, has been very, very good. If you see overall, we have been able to demonstrate clearly a working capital reduction.
Hi, welcome back to Buy Now, Sell Now here on ET Now. We're joined by a very special management. Amit Agarwal, the Group CFO at Raymond Limited, is now with us. Good morning, sir. Thank you for taking out the time to talk to us here on ET Now. Of course, Raymond is in focus for a lot of investors. And based on the recent numbers which have been reported by your company, we'd like to know how has demand fared if you were to break up the year, H1 and H2. Are you satisfied with the level of recovery that you're seeing, or do you anticipate a further acceleration towards normalcy in the quarters to come?
Yeah, no, absolutely. I think there's a sea change if I look at it between the H1 and H2, which has been clearly witnessed in the Q3 performance. We have seen a significant impact of the unlock, where all the stores got opened all across the country. So we were very satisfied with that the stores were able to open. Even the shopping malls, the cinema theaters have progressively started to open. People have started to come to the stores. And obviously we manage all the right procedures for the health and safety. And after that, if I look at it, the wedding season and the festive season with the Diwali and the Dussehra, which really propelled the customers, our consumers, to come to the stores and pick up the various fabrics or the other demand which they wanted. Second thing, we have also seen that people who have not been able to shop for a longer period of time during the lockdown, they wanted to come and express their desire to shop, which has been reflected clearly. And if I look at our TRS stores, which is the core strength for the Raymond Group, all across 600 plus cities in India, we saw a very good recovery coming back there. People, especially on the fabric side, they have come around and bought fabrics for their needs, whether it is for the wedding season or for the festive season, festivities, they have come around. And if I look at it, and Raymond is a diversified conglomerate, so you see the engineering and the auto business, as all of you are fully aware, that auto sales are at a record levels, and we have witnessed both in our engineering and auto sector also very, very sharp recovery, and even exceeded the pre-COVID levels in both these sectors. Then on the real estate side also, if I look at it, because of the reduction in the stamp duty, as well as the all-time low interest rates on the home loan, we have seen very significant bookings in our Thane Realty project. We sold 179 apartments during the Q3. So all in all, we say there has been a very good recovery across the businesses. Obviously, we expect that the recovery will be at a certain pace. We do not believe that in this fourth quarter, in the current fiscal quarter, we will see the 100% recovery back. But we are seeing an improving trend compared to the H1. Clearly, H2 is significantly better. As we have told earlier, around that 75 to 80% recovery level, we are seeing that to happen in the H2 across the businesses. And going forward, maybe in the next fiscal, let's say 21-22, we should be seeing by second or the third quarter almost full recovery to be back.
Right, sir. And, talking about some of your input costs, of course, there's been a lot of fluctuation in domestic cotton prices lately. We're picking that up from various cotton producers. So what has been the consequent impact of that on your raw material costs going forward, and how do you plan to hedge against any volatility in cotton prices going forward?
So look, for us in the cotton, we consume the cotton not so significant in many areas. In our denim business, we consume the cotton. But since we have bought most of our customers in the international markets for such product, we are able to pass on to a great extent. Second, it is going to impact the overall sentiment of the industry. However, for our main business, which is the woolen poly wool, we have not seen a dramatic increase in the raw wool prices. It continues to be lower. There is a small increase. I would not say absolutely at the lowest level. There has been a small increase, but in the overall scheme of the things for us, the raw material constitutes not a very significant portion because it's all a design and a fashion. We are not in just a commodity play. We are in the fashion play where the raw material cost is a smaller component. And considering the strength which we have in our products, we are able to pass on here and there the price increases.
Given the higher discounting trends, how do you see the margins panning out? And even in the quarter gone by, what's been the impact of discounting on the margins, and how are you managing your liquidity situation and working capital management, etc.?
I think that's a very good point that in the Q3, we have seen ourselves that since there were inventory and sitting in different products, be it the shirting fabrics, be it a little bit of the suiting fabric, on the apparel especially. So we have also gone out and given some discounts, which has impacted to an extent a gross margin. However, our working capital management, I think, has been very, very good. If you see overall, we have been able to demonstrate clearly a working capital reduction and controlled working capital reduction in spite of increasing the revenue numbers from a 700 crores to close to 1300 crores from Q2 to Q3. But our controlled working capital management enabled us to reduce our debt by over 230 crores during the quarter. So this is like our effective management of working capital, cost rationalization helped us to achieve a decent EBITDA. And if you see our EBITDA margins are slightly higher compared to the previous year. And this liquidity has enabled us, this working capital management, cost rationalization has enabled us to reduce our debt on the balance sheet. So our net debt is below 1600 crores, which clearly demonstrates the path for the company that we are focused on deleveraging the company as well and improving the margins of the business. And we continue to maintain a healthy liquidity of 600 crores at the consolidated level, which is very, very strong.
Okay, and how much of your business or your sales are coming from online now versus earlier? How has that trend evolved? And if you have any plans to leverage your digital and your omni-channel presence further to tap into this segment?
Again, you see, digital is an important thing, and especially post-COVID, one has really understood, and our drive on the digitization has improved a lot. And I think what you mentioned about the omni-channel is very, very critical, because that omni-channel is one thing which we are very uniquely placed, because we have got across 1600 stores. Now we have enabled our teams to demonstrate and put forward the entire inventory which we have across the country can be displayed digitally. So you as a customer have a possibility to pick up one product digitally, get it delivered to the store near your home or near your office, or if you buy something, you want to change it at our store, that can be possible. So there are various ways by which omni-channel presence enables us. Similarly, we can launch our fashion digitally all across both online, offline at the same point of time. So the reach has made it very, very easy. Our online sales, obviously, which was there, has improved significantly, but it still is not a very significant number that one can say that it has moved to a certain channel. We are present on the online marketplaces. We are doing our myraymond.com, and that with our strong leverage on the our My Raymond Reward members, which is 8 million plus members, that brings us more connect and loyalty to our program. So I look at it, this is what we should call brick and click, which used to be a brick and mortar. Now it is actually moving to a brick and click, where people can use these stores for their convenience, for trials and so on and so forth. Because if you look at it, whenever you get a stitch a suit, you want to go have a trial, that can be done. Maybe you can online, place an order online, get it altered at our store across the street. So these are certain advantages which we are enabling our customers to benefit from.
Okay, Mr. Agarwal, thank you so much for joining us this morning to talk about your numbers and the way forward. Moving on, we caught up with Vinod Gupta of Dollar Industries. He shared his view on whether or not e-commerce boom is here to stay. Listen in. Talk about e-commerce, because that is a space, a domain that has seen a very solid surge in the months that came by after the lockdown, and it continues to be quite strong. Do e-commerce sales continue to be as strong for your industry and for your company as well? Because now that stores and marketplaces have opened up, what is the demand mix like? What has been the contribution for Dollar from online platforms, and if you have any plans to scale it up further?
Right now, we are present on all the important portals where the goods have been sold. Last year, we had a turnover of around 1.5% of the total sales were out of this online platform. And now we are gearing it up. As I told you, that people are not stepping out of their homes. They are preferring buying the products online. So we have also stepped up how to increase the sales online. We are offering good amount of discounts so that the total number of products being sold online are getting increased. And we have seen a very good result in this current financial year. And we are fully much geared up to reach to a level of around 3% of the total sales in terms of online sales. And we are now, as on today, available on all the important portals which are being offered, which are offering our products to the consumers all across the country.